All right, good morning. Today is Thursday, August 20th, 2026. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as all of our different social media pages. If you are with us live or if you are watching in the recording, we do appreciate you taking some time out of your busy schedule to be here with us today. If you are joining us for the first time, my name is Eric Hagan. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of financial advisors Dan Oshman, Rana Grant, and Jeff Halverson, and our awesome client support team, Ann Colian, Josh Denny, and Karen Miller. Together, we help successful families identify the risks they don't see, protect what matters most, and align every resource they have with the life that they want to live. And it all starts with an understanding that our clients are at the center of everything that we do. We come alongside them as their financial director, and we look for two things. One, we look for opportunities, and two, we look for potential train wrecks. We look for opportunities and risks in the areas of their investments, taxes, estate planning, insurance, titling and beneficiaries, Social Security, and more. So if you're hearing this for the very first time, if we've never had this conversation, I invite you to schedule a face-to-face conversation on our website, which of course is www.investwithccg.com. Today, we're going to learn more about the risks and opportunities in the economy and the markets as we hear from our guest speaker, Tom Fox. Tom is Chief Investment Strategist with Water Street Research Partners, and as always, I am excited to have him here with us today. Tom spends all of his time more behind the scenes, doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. Tom has almost 40 years experience building investment strategies. As you can see on the screen, he has a very impressive long resume. Today, Tom will review the positives in the markets, the headwinds, and give us his outlook moving forward. Ultimately, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in the markets, in the economy, and what we're watching for. So I encourage you, if you have any questions, please do not hesitate to ask, and I will review them at the end during the live Q&A. And you're welcome to submit your questions during the presentation as you think of it, and I'll bring them to Tom, like I said, at the end. Or you can also send them to us if you're watching in the recording. We would love the opportunity to circle back with you. You can text us, you can email us, you can also submit your question in the comments section if you're watching us on one of our social media pages. I will be watching all of that during Tom's presentation. If you're on our website and you want to ask a question more anonymously, there will be an Ask a Question button underneath this video later on today. And again, if you're watching in the recording, we would still love to answer any questions that you have. So again, please do not hesitate whatsoever. With that, I'll bring up our theme for 2026. I'll bring Tom onto the stage. Tom and I were talking for a few minutes here prior to going live, and just kind of reflecting on the year so far and how much volatility we've been seeing. And anyway, I will pass it on to you, Tom.
Thank you, Eric. Hello, everybody. Well, 26 things have changed, and AI is the culprit behind most of this change. Of course, the Iran and oil, which we'll talk about more later, but things have changed, and it's exciting. And I don't know if you remember, I think Eric sent something out that at the beginning of the year, it might have been even end of December, that I said we would experience high extreme volatility, and it would be both ways. That means up and down and back up. And that's exactly what we experienced. We saw in July, the markets come down, and then right so far this month, we've seen them come back. And that's what we expect all the way through to the end of this year. But we'll talk more about what we see as we go forward and what our outlook is, how it should shape up, what we think will shape up by the time this 26 closes. So here's our outlook. And of course, we always want to start out with why we should be worried. And there's many things we should be worried about today. One is long-term yields are flashing a warning sign. We'll see a chart on this, but global long-term 30-year bond yields have decades high currently, which causes raising borrow costs, but also pressures valuations potentially in stocks when you have a better option, let's say in long-term yields, where you can lock in a 5.2 something 30-year treasury. Of course, that's not much. That doesn't give you a lot of room over inflation, but it does start to create some competition for stocks. And we're seeing that all the way across the economies and different global economies. And there appears to be no apparent end to the Iran war, continued conflict, uncertainty. We got oil, we've got risk to oil, inflation, and obviously the stock market. So that's out there. And there's some new news that just came out this morning, which I'll be sharing from Treasury Secretary Bessent, that I think could end up bringing an end to this war. And so oil could reignite, because obviously oil prices, you got to transport all the goods and things that we get here in America and across the world. So oil is a big component of inflation costs. So if there's more disruptions, or could even drive oil prices higher, obviously that could have a big impact continually on inflation and its progress. And then we have inflation isn't defeated. Recent data has been improving. Energy tariffs, wages, supply chain pressures, they all remain a risk out there, all related to oil and Iran. And then we have government deficits. There's been a lot of talk about how not only the US, but globally, the amount of debt that governments are having to fund, and that could bring heavy borrowing. It could also create a problem with many other things. Financing, we're financing AI like unprecedented. We'll see like that, and that's been competition for the government bonds, but we'll talk more about that, and we'll look at a chart. And then we got large cap US valuations, they're elevated. And so when you have high valuation on our large caps, US, it could present potentially lower returns in the future. And that's been sort of a historic thing. If you have a certain PE ratio or above a certain PE ratio, that it tends to mitigate the total returns going down the road in equities. And of course, AI expectations are very high. The amount of money that's being spent in AI by large companies, unprecedented. And of course, the big thing is, will it pay off? Will it generate attractive returns? And of course, nobody knows that, but many companies are betting that it will. And then we're late on the economic expansion. We're maturing. Growth remains positive, but slower employment growth and high borrowing costs warrant some attention. Are we in the late innings of this economic expansion, or just beginning with AI? So that's all a risk out there. And then, of course, you got the geopolitical risks. You got Iran, Russia, and then we got China, and all these others, which we list at the back end of our presentation. And markets remain vulnerable. And we saw this at the beginning of the year. That's why we forecasted extreme volatility, because you can have sudden shocks when you have high valuations. You got a lot of leverage, crowding, and so on, concentration. And so any relatively small disappointment could disrupt the market. And we'll talk more about that as we go through the presentation.
A lot of things causing volatility to the downside. Let's look at those causing volatility to the upside.
Yes. So here's the good news. The S&P 500 recently broke out of an 8-week consolidation. Technically, that's a good sign. Now we've had pulled back a little bit from the recent high, but it is a good sign when you break out of a long channel that has been sort of just going sideways. And that could end up meaning that we could go to even new highs as we move forward. And we saw that almost a new high in the S&P 500. So we're down a little bit over the last couple of days, but this can change on a dime. So we'll see what happens. Now, this is a big one because there was a hedge fund that was 400% leveraged in AI stocks. And they were huge leverage, and they had lots of money in this hedge fund. And what happened is when the AI tech stocks started pulling back, they had to go and fill in the margins that they were using. And of course, this caused a compounding effect. We saw that in July. But based on what we see, we estimate 95% of that leverage has been worked out. And it happened in July, and we saw a big recovery end of July, early, and of course into August. So we think the leverage problem has been undone, which could put pressure on the upside. I mean, on the downside. Now, here's another one, Korea, which they had huge leverage in Korea, and the panic maybe marked the bottom. Policymakers started intervening. And typically, this is a sign when you get politicians intervening on the deleveraging in a country like Korea, that typically marks a bottom. And so this is sort of a contrarian thing. When politicians panic, that's probably a good time to buy. And we think, again, 95% of the forced selling is probably done at this point. Now, here's another one, no Fed meeting, not till the middle of September. So we got some space here. We don't have to worry about what the Fed's going to do. And there doesn't appear any imminent Fed decision coming either way, lowering or raising rates. Another one, this is huge. This is what's driving this. There's a war going on, Eric, between oil and Iran and AI. And AI has been blowing it out, and its impact on companies. We saw earnings, 88% of the companies so far, 91% have reported, have beat the estimates. That's a huge number. And then we saw what was the surprise size? 28.4%. Not only did most of the companies beat their estimates, but they blew it out on by how much. This is spectacular earnings. And we even saw excellent revenue increases. So this is what's upholding this entire market. And even though we tend to have higher valuations on the higher end, but the earnings are supporting it. And of course, if you have a PE ratio, price to earnings ratio, if that the earnings component, continues to rise as fast as it is, it keeps the PE ratio where it is. It doesn't go higher because the earnings are driving that PE ratio down. So, or holding it in static. So this is really good news. Another good positive is that market leadership is broadening. We've seen financial, industrials, other areas of the market, healthcare, begin to participate in the bull market. So that's a very healthy sign that a bull market has more to run. And of course, then we have the corporate balance sheets remain really healthy, strong cash flows, supports investment, dividend, buybacks, acquisitions. All of this is a good sign of a healthy bull market. And then we have trillions. We're at probably record high for the amount of cash that's in money market funds. Well, what if the Iran war got solved, Eric, and you have all this gunpowder on the side, and those investors start to say, hey, I think I'm going to get in the market. That potentially could drive this thing much higher than we've experienced. And then, of course, you got the powerful secular themes, remain intact. And of course, AI, robotics, biotech, electrification, grid, all the infrastructure around it, that could potentially cause multi-year growth opportunities in corporate earnings and revenues. So all this, in our mind, we think it outweighs the worries. And of course, the old adage, all right, we'll see that on the next slide.
Worry.
That's right. Market prices are elevated, but not collapsing. But stocks continue climbing the wall of worry. There's always worries about this or that. But we believe today that the current positives are slightly outweighing the negatives, which we think we'll see at the end, but we think there's more to come. Excellent. All right, let's look at valuations. I thought this was an interesting chart. And if you look in the middle, you see that green area, if you can underline where the arrow is, you can see that valuations reached overvaluation, but look how long it lasted. It can last a long time. Of course, we had the 29, and then the Depression. You can see how high it got. And then in 1999, we had the tech mania. And look how long that stayed up. But where are we today? We're still below the line. And we think we could have a prolonged period above trend. And we haven't even entered that point yet. We're kind of on the edge. But if that happens, we could end up being a long-term bull market. So this is a very interesting way to look at valuations. And of course, the question is whether the conditions are here. What's condition? Well, you have high valuations. But is there a catalyst to bring down the stock market? And currently, there is not a formidable catalyst to bring this market down, such as falling earnings, falling revenues. The war in Iran goes to a new level. We don't see a catalyst right now. And high valuations have never been a good timing indicator for when to get in or out of the stock market. Now let's break out tech and AI valuations. This is relative, the forward PE ratio relative to the S&P 500 technology. And if it's above the gold line, it's tech has more expensive. If it's below that line, it's less expensive. And you can see where we are on a relative historical basis back to 21. There could be more room for tech. And this is after, of course, July's numbers. This is through July. And I think it's just starting to come into August. So what we saw was valuation relative to the S&P. Normally, tech has a higher valuation historically. A lot of it, what's the reason is growth. And you can see that today, it's not on a historical basis, it's still reasonable. So we think there's more upside in tech and AI. We had an extreme downturn in July, and now so far in August, we had a big upswing. And we'll see where it shakes out. But we think that tech and AI is still historically reasonable. Here's what we talked about, that the S&P recently broke out. This is good for technicals. You can see the 8-week sideways move kind of within a channel. And then, of course, we busted out of that. That's a good sign that we could go to new highs. Now, we went through that, and we've had some volatility here the last few days. We'll see where it shakes out. But so far, I think this is a great technical indicator. Here's another look at the earnings. You can see the S&P 500 for the S&P has been revised higher and are broadly positive across sectors. And then how much higher? Well, you can see the S&P is almost 30% higher. And that's amazing. That's amazing increase in expectation for earnings. So again, it's another way to look at it. You can see the S&P 500 in the middle. You can see energy and tech leading those earnings expectations higher. But it's what I note, Eric, is that all are positive, not even all the way to
Yeah,
healthcare. They're
good
all
point.
positive. You don't see that often where everything is positive, where every industry and sector they're raising the expectation for earnings. This is good news. The next chart will give you a little different visual. This is the path of breaking the cycle here. This is earnings growth estimate path, and it's from 21 to 27. But look at 26. You can see where the arrow is, the blue arrow up there. It has broken out. This is an amazing increase in expectation for earnings because corporations continue to beat the estimates. They continue to drive it by quite a margin, outdrive it. So this looks very good. This is unprecedented. And a lot of this behind this is AI, and AI is impacting every sector of the market. You can see they still have 27 going lower. We'll see where that shakes out. But look at 25. Look at the other years. That's normal. We're having unprecedented breakout in earnings growth. That drives stock prices. Retail sales, they came down a little bit recently, but you can see the trend is still higher. You get occasionally periods where it goes down, but you can see it's still looking above trend. And so retail sales has been hanging in there. Of course, 70%, we talk about this a lot, of the economy is consumer spending. So it's still high. You can see it's still above around 3.8%. And so it's still on the higher side, and it continues to move upward. And of course, if portfolios and 401ks go up, that helps in consumer spending.
Absolutely.
And this is tariffs. You can see how high they were back when President Trump first started putting tariffs on. They're elevated still, but you can see they're stabilizing. So the forecast is they're going to stay around that 10%, maybe slightly higher. But now everybody's adjusting to that. And I think it's good for our budget and trying to bring our deficit down. But it seems like it's stable now and not rising fast like it did in January and February and March there. So this is probably a good sign going forward for tariffs. All right. So there is concentration risk. And of course, when you get one sector dominating a particular overall S&P 500, you can see that across high yield bonds, investment grade bonds, small caps, private equity, private credit, even venture capital, 57% is going into tech or AI. But look at the S&P, 47% of the market cap is S&P, of the S&P 500 is technology weight. That's high. So you have to be very careful as a money manager, navigating, making sure you own the right stocks. And that's what I spend all my time doing, is evaluating which stocks and AI or tech to own and which not to. So this is you have to manage it, but there's concentration risk, but we're on top of this in evaluating stocks. Okay, here's the other, is you can see the amount of money AI needs to build out their infrastructure. And the vast majority in the US has come in a form of investment grade bonds. This is one of the reasons why global treasuries have gone up so high, the yield, because there's not much volume. Where is the volume going in the 30-year treasury? It's going into these tech companies that are blowing out revenue and earnings. It could be as safe or even safer than the US government in some cases. Some view that way. But what it shows is that there's high competition for bonds and people obtaining yields, and lots of institutions are buying these bonds. You can see how much is in US leverage loans or high yield. And of course, across the line there, you can see that US is dominating in this area. That's good for the long term because AI is the future. So I think this is just ends up doing very well for productivity, corporate efficiencies, and the way we run our companies. And it's just going to improve, improve, improve as we move forward. Now, this is strange, Eric.
Yeah, it is.
Marjorie Greene, former congresswoman, posted this strange text, and it immediately impacted oil prices and yields the next day. Look what it says. They are discussing using the US government nuclear weapons on Iran in strategy meetings. Yes, you read this correctly. It's real. I'm not speculating. I know. Of course, she's not even in Congress anymore. But it had an impact, temporarily at least, on oil prices and yields. And that's why we saw them jump up. Now, if you go to the next chart, you can see how much they jumped. They just went from $80 all the way to 85. And you can see the 10-year jump to 472 on. And that last jump was her statement. Now, let's look at it on a bigger picture. This is looking at a little longer term. We're seeing, you can see where Trump put the tariffs on and it reached its peak. This is oil, crude. And then you can see where recently we've had it go back up again. And of course, it was working its way down, oil prices, and it still is coming down. But you can see what happened here, that it's not anywhere near its peak. And I can't see the date. Maybe Eric, you can read it. But you can see, what's the date?
At the very end?
No, the Trump peak.
Oh, the Trump peak was mid-April.
Okay, mid-April. So you can see where it peaked out, and that was the Iran war, excuse me. So, but it's not reached its peak again. And I think Treasury Bassett just said, the Treasury Secretary just said this morning that they're going to do what is called economic sanctions warfare against Iran. This is, it's going to be unheard of, unprecedented, that if you want to do business with Iran, there's going to be steep consequences from the US, and that could be in the form probably of tariffs. But this is going to be coordinated around the world. Of course, Saudi Arabia just stopped doing business with Iran. So this is the beginning. And what they're expecting, what he believes, is they're not going to have to use kinetic bombing to change the regime, or they're going to economically beat it by warfare, by cutting off their supplies. And they think this has got the higher probability of a regime change. So that's starting over the next 2 weeks and month. And this potentially could bring an end to the Iran war. And if it does, it's successful, like it's successful in Cuba right now. It was in Venezuela. They think they can do this. And if it happens and it does pressure the current regime in Iran, and that becomes a reality, what do you think, Eric, stocks are going to do?
Well, they would love that.
They would love it. And potentially we could see all that, a lot of the cash that's on the sidelines go back into the market. If this Iran war gets dealt with, because AI, it's the battle between AI, efficiency, productivity. We've seen that in earnings, and of course, the oil prices by Iran because of Iran. That's the warfare. If one gets solved, then we're riding AI. So we think it's going to happen. We're not 100% sure, could be wrong, but we think they could be successful, and this could be a game changer. Again, this was just announced this morning.
Interesting.
All right, here's the 30-year yields rising globally, 15-year to 30-year highs. And again, what's caused this is the amount of deficit, the amount of interest that these countries have to pay, and of course the competition in investment grade AI companies bonds has taken a big piece of this. Now the U.S. Treasury has just started buying bonds. They've doubled their purchasing of U.S. long-term bonds, and they may even go higher. So they're kind of offsetting this, and we'll see where it goes. Of course, it dropped as soon as he announced that. Bessent announced it, and the yields dropped from their peak. But this is an ongoing problem. It doesn't give the governments a lot of leeway and what they can spend money on. So this needs to get resolved, and we think it will eventually. All right, in recent inflation numbers. Now, this is a surprise. They've been good. Let's take a look. Of course, oil remains the pricing remains the big risk. But you can see we've had several months of lower headline and core. And so the market 10-year expectation has dropped a little bit. We've seen a couple good numbers in the CPI. So we'll see what happens. We may have a temporary hold on that, but we think the trend is going to be lower. And again, if Iran gets settled out, you're going to see, I think, inflation go to that 2% target the Fed wants. Oh, here's a big one. As a result of these new numbers, it looks like, remember we were, 67% in July expectation for a rate hike? That has fallen down to 29%. Now, this moves every day. I haven't looked at where it is today, but you can see the trend that now there's not an expectation for a Fed to hike in September. This is good news. Here's one of the components of the CPI that's helping a lot, and it's got a visible downtrend, and that's housing prices. Obviously, that's a big component. It supports lower CPI, and you can see we've had 3 negative months in a row. So this is trending down. This is a large component in the CPI. So this will help the overall number. And we're expecting this trend to continue at least for another several months. All right, we're going to look at long-term positives for stocks. This is not long-term. This is what we call a secular cycle, not a cyclical cycle. Cyclical cycle is shorter. That's what we normally think of. The secular is really long-term cycles. Now, this chart's hard to see, but you can see the number at the top, that red line going across. We've almost touched that line historically. And the black line, the line going through the chart, is the 10-year rolling returns for equities. Now, look where we are today. We're not even at the peak. And we think with AI driving a lot of the increase in earnings and revenues, we think we could end up going back to that number. Well, there's a lot of numbers on here, but we've been in a 17-year secular bull market. But it could mean and we were only at 76, 74 today. We could end up seeing expanded S&P 500 numbers much higher than we are right now. Now, could it reach 16,000 by 29, the end of 29? I don't know. But this is a long-term chart. This is not one you would use for market timing, but it does give you some indication there could be tremendous upside to stocks over the next several years. And another one is the demographics peaks. When you have different generations peak, and you can see that the market tends to come down, and that's where bear markets happen. Well, the next one isn't until 2038. Now, these are long-term demographics, but they point that we may not have a bear market for a long time. Now, again, we don't use these for cyclical outlooks, but it's interesting that both the 10-year return on S&P 500 and the demographics are pointing to that we may be in for a longer haul in a bull market. Now, remember what's going on. Well, in between those lines, that's when they're spending. They're buying homes. They're spending more. And then when it reaches a peak, when a great amount of a generation reaches the peak, then they go into saving more. They go into retirement, things like that. And it begins to bring it down. So we'll see where it shakes out. Again, these are long-term trends, but it's interesting. They are both pointing to a bullish future for stocks.
Yeah, very interesting, Tom. I know demographics point to a lot of stuff.
All right.
All right. Yeah.
Are you ready? The drum roll. All right. Everything's the same.
For us.
But we added one line. Extreme volatility both ways. We've had that since the beginning of the year. The economy slows, and we're expecting a 2% GDP, but no recession. We don't expect one. War in Iran comes to an end. Now with the new financial warfare that's going to start, that may happen sooner than later. And we're continuously bullish on stocks. We see pullbacks and weaknesses, buying opportunities. And of course, you can see the catalyst, policy support, earnings, AI-driven productivity gains. Now, we do think, and this is where you get the most volatility, is in AI tech. And we think they'll be up and down, but at the end of the day, they'll continually lead the other sectors of the market. Here's what I added, Eric. Expect another correction, maybe even before the fourth quarter. What is a correction? That's 10% plus, but not a bear market. And of course, it's very difficult to try to time a correction. Very difficult. What we try to avoid and take some money off the table is if we expect a bear market, which we do not. Every year, almost every year, we see one or two corrections. So we think there's a potential for one more. But by 12/31 of this year, we're up in the 10-15% return by year end. It could exceed our forecast. So, of course, we have our wild cards, and the three highlighted in red triggered this year. Some of those could go back to gold. And if that happens, that's going to be good long-term for this stock market. So there's my forecast. I haven't changed it much. Still, we expected a good year, but with extreme volatility since the beginning of the year. And that's exactly what's been happening. And by the way, volatility both ways. That means AI tech could lead down in high volatility or up to new highs in high volatility.
Very good. We appreciate you, Tom. I never want to try to summarize what you said, but as you said it, not a whole lot of changes, but that additional line there of expecting another correction, that's, I think, I read that as a friendly reminder that what you projected back in December of extreme volatility is to be expected to continue. And just also for everybody watching, just a little bit deeper on what is a correction. It's a pullback from a high. So whatever the high is, and you got to look at it every day to calculate it, it's a 10% or more pullback. And bear market is when you get down 20%. And it's the bear markets that we watch out for when we might take action if we think something like that is coming. But as I'm hearing you, Tom, we expect more volatility, but for right now, continue to stay resilient, continue to stay invested, committed to the investment policy statements that we have on each account, and ride that volatility. And friendly reminder always that if you're concerned about the volatility or you feel like it's too much, reach out to me, reach out to your advisor, Dan, Rana, Jeff, and have that conversation about how much volatility is right and how much is too much. And have that discussion. That's very important. So thank you, Tom. As always, definitely very much so appreciate your balanced approach to all of this, weighing the positives, the negatives, and summarizing it so clearly and concisely of what you expect to see coming. With that, I will open it up to any questions. Feel free to drop a question in your email. You can send it directly to me. You can also text our office number if you have any questions, whether it's now or if you're watching in the recording. Would love to circle back with you. I did get a couple of questions come in here, Tom, while you were talking. So if I need to go back to any slides, just let me know. But first one, actually, I don't think you really talked about. As you know, a lot of clients rely on price appreciation to see the value of their accounts go up. So we spend a lot of time talking about that. Where's the market going and what's the target returns and all of these things. And a lot of clients rely on dividends coming into their account, that income that they receive into the account to help the account as well. Can you speak to the dividend side of the equation? What have you seen with dividends keeping up with price appreciation, or what percentage of returns, total returns, is coming from dividends versus valuations?
Yes, and this has been a chatter among a lot of financial people, is that people are living longer. And so the old numbers that we used to calculate to determine, when they would probably expire, have been changed because medical healthcare is improving, biotech, health, drugs, especially with the AI. We're at the beginning of tremendous AI intervention and new ideas, new concepts, and new medications for people to live longer. So the expectation is we're going to live longer, maybe longer than we expected. That's why it's important to look at total return, because you want to make sure that you're growing at some level, because you may outlive what you initially thought. And
Right.
you could talk probably even more than I could on this, but I think that's something to think about. So that's where the wide moat comes in, because it's got the highest growth potential, and thematic combinations. So, but if you need income, there's two ways, Eric, you can get this. And one is by making the money available, selling off some of the positions, or dividend. And so I'll leave that to Eric. He's the one that decides all that with you. What do you think, Eric?
Yeah, very, very well said. Ultimately, to your point, it comes down to a one-on-one conversation about what the right mix is for each and every individual account that we're talking about, and the order that we're spending the accounts, and what the goals are for each account. So very well said, Tom.
Thank you.
Did have another question come in, and this is a little bit more timely with what's on the fall calendar, and that's midterms. So ultimately the question is, what is the impact? What do you think the impact midterms will have on the markets, on the economy, as well as the hard pushback against data centers and how that impacts AI and associated stocks?
Well, for let's hit the second question. Meta recently is creating a fund wherever they build data centers. they're putting $1 billion in a fund for the benefit of the community to offset sort of the negativity of that. And of course, energy supply is the huge piece there. Will it drive up electrical costs and so on? But nuclear is really starting to take off in other forms of energy production. There's natural gas and things like that. So I think Meta has a good idea, and that's kind of putting a carrot in so that they're gonna do it somewhere. Some community will allow for it. So I think some won't. And so it may depend on their political side they're on, but I think they're still going to build them out. I don't think they're going to stop. And that now this $1 billion community fund should help that decision. And then the other question was
midterms.
Typically, yep. Markets go down prior to the midterms, and because of the fights between both sides of the political spectrum. However, about maybe 15, 20 days before the midterms, the market turns bullish. And I don't know exactly why, but that's the historical. So we may see from midterms, fears up and down, but then all of a sudden, prior to the midterms, the market takes off, and it could be in October, middle of October, beginning of October. That's the historical. So it is a factor. I don't think it's a huge weight, but it does impact prices somewhat. But we could see a huge move upward around that October 15th period.
Great. Thank you for that, Tom. As everybody, I think, knows, Tom is in Eden Prairie joining us today. I'm at our new office, still putting it together, but our new office in Bloomington. And our questions today, Tom, kind of fun, came from Indiana and Texas. So we are all over the place. Love it.
Wow.
I'll leave it for another minute or two here. If anyone else has a question, I see a bunch of you out there. So if anyone else has a question, would love to field those questions for you. Again, email, text us, and I'll bring those to Tom. While you're thinking about that, I will go through a couple of slides here. We are recording today's presentation, so it will be available on the website later on today. I'll also have a nice summary that you can download if you'd like that. So it's all the positives, the negatives, and then that outlook that Tom presented right on there. And then if you'd like to ask a question more anonymously or more directly, welcome to do that as well. We'd love the opportunity to circle back with you. Our next monthly presentation is scheduled for Thursday, September 24th. So mark your calendar. It is on the website. If you drop in your email, I'll send you a little reminder the day before, the morning of, that we will be going live. And then a reminder, every Monday morning, 9 a.m. Central, I start my week off with a more brief update on what's going on in the markets and the economy, some of the things that we're watching for in the week ahead. Just like today, this is broadcast on our different social media pages, things like that. And then I send out an email with a link back to that recording. So if you're not getting that and would like it, you can subscribe to that at our website, of course, investwithccg.com. If you put in /WEVU, weekly economic video update, it'll take you right to that page. And then really some fun news, looking forward to it next week, a week from today, in the evening, we have our big annual client appreciation dinner cruise. We have a lot of people signed up. I do believe there's a few more openings. So if you're on the fence and would like to join us, I encourage you, reach out to Ann here, go to the website, RSVP, get your name on that list. We would love to have you out. Tom will be on the cruise, and so we're going to make him work. So if you have any questions, bring your questions, have that conversation. Tom will be there, and I know he would love to talk about it because he loves talking about the markets and the economy. Right, Tom?
That's right. And I look forward to this every year. My wife and I will be there. This is a highlight for our summer. And I typically sit on the second floor outside. So
outside.
it depends on the weather, of course. I hope it's good. But if it's good weather, we'll be up there right outside. So come see me. Come talk to me.
Yes.
I'll be there. And my wife
Come up,
already
say hi,
knows I may be
introduce yourself.
talking. So she already knows.
Right?
Yeah. So come see me and visit me up on the second floor. Usually that's where we sit.
Absolutely. Yeah, the last few years we've had wonderful weather. It's about now that I start looking at the forecast to see how it's going to go. But rain or shine, the cruise goes. They are well equipped to accommodate us, even if it is raining. So very, very unlikely that the cruise would get canceled. Okay, well, I don't see any more questions that came in. So I will wrap us up. Tom, any closing comments? Otherwise, I
Well,
can close
first of
this
all,
up.
I'm going to look, Eric, and see what it says.
Yeah. What is the forecast saying?
It's Thursday,
Yep.
sunny, 100% sun, 83. So I'll probably be on that if it holds, the weather terrorists out there. But we'll probably be outside on that second floor.
Yeah. Come ready. Introduce yourself. Would love to have you have that time with Tom. So,
And
all right.
just a
Well, thank you
thought.
again, Tom.
Yep. Thank you. One thing, just
Yeah.
remember there's always volatility. Corrections happen almost every year, sometimes two, even when the market reaches new highs. So that's what we would just prepare for that. Close your eyes and blink, and we'll see you on 12/31.
Yeah. Don't be surprised if there's a correction. You
Yes,
heard it
don't
here.
be surprised. We don't know if it will happen. It could happen. We got the midterms and so far, but the market tends to turn around before the midterms, like sometime in October.
That's right. All right. Well, thank you everybody for joining us today. Really do appreciate you taking the time with us live, or if you are watching in the recording. That concludes this month's Capital Markets Update and Outlook for August. Hopefully we'll see you on the cruise next week. If not, we'll look for you in a month at our next monthly update. Thanks, everybody.
Thank you.